Imagine a farmer who earns less than 3 lakh rupees per year under a lot of stress due to multiple loans that he finds very difficult or almost impossible to pay back. What would he do? And how would his failure to pay back these loans affect the bank? And how would the bank's failure to get back the money affect the Indian economy? This is the story of the world of microfinance companies as they are in trouble, which in turn is also impacting the Indian economy at large. And to understand how, stay tuned till the end of this video. First, let's take a look at what microfinance institutions, commonly called MFIs, are. Well, microfinance companies are basically finance companies that provide small loans to low-income individuals who don't have access to traditional banking systems and whose annual income is less than 3 lakh rupees. And therefore, microfinance customers typically hail from rural areas. Now, to give you a few examples of MFIs, there is Credit Access Grameen, Satin Credit Care, Spandana Spurti Financial and Fusion Finance as examples. Now, three very important factors to note about MFIs here are: 1. They depend on banks like Bandhan Bank, RBL Bank and Yes Bank among others, and also large non-bank lenders for funding at very high interest rates. 2. Their business model is high on costs because they have to send people to borrower homes to lend and collect loans. And 3. The risk factor in these loans is even higher since these are loans where the lender does not take any collateral, and that is why MFI loans are more expensive. But how did MFIs really get into trouble? The main problem is that MFIs have been lending money to borrowers who are over-leveraged, which in turn is hampering their asset quality. Basically, over-leverage is a situation where someone has borrowed more money than they can repay. And at present, some of these borrowers have taken loans from more than 4 lenders, making them financially very vulnerable. This in fact goes way back to 2010 when the world of microfinance was rocked by Andhra Pradesh crisis. That was a turning point for MFIs in India when the Reserve Bank decided to bring tougher rules for all such companies. The regulator set a cap on the interest rate at which MFIs could lend money, where they allowed MFIs to add up to 12% to their cost of borrowing. This meant if it costed them 10% to get funds, they would charge borrowers an interest rate of up to 22%. But cut to 2022, the RBI decided it was time for a change, and it decided to remove the maximum rate cap and allowed lenders to decide their own lending rates. But this became more problematic as some MFIs used this to raise interest rates further to unmanageable levels, forcing the RBI to come back and take note. Now imagine the same farmer I mentioned before, and imagine how would a low-income individual like him and many billion others in India with the burden of multiple loans pay back at such a huge interest rate. They really would not be able to. To give you a fresh example, Credit Access Grameen's PAR, which is portfolio at risk, and loans overdue by more than 15 days is 1.5% nationally, which is not bad, but if you look at it at a deeper level, the number turns to 8.9% in Bihar alone. Therefore, to protect themselves, CA Grameen is keeping provisions of 1.79% above what regulators require, giving them an extra buffer of 431.1 crore rupees. But the direct impact of this provision is that their profit after tax dropped 46.4% year-on-year to 186 crore rupees. Also remember, these factors heavily influence the economic health of the country in the longer run as well. So what is the solution now? Well, to begin with, lenders need to be more responsible. The Microfinance Institutions Network, which is a self-regulatory organization, has decided to curb the exposure of a borrower to 3 lenders from 4 earlier. The second solution is that they would not levy any hidden charges on their borrowers. And third, it has also capped the maximum indebtedness of a borrower at rupees 2 lakh, including both micro and unsecured retail loans. So all in all, while MFIs play an extremely important role in financing low-income individuals, they also need to play it safe by keeping interest rates in check. So if you like such explainers, then do let us know in the comment section below and stay tuned to NDTV Profit.